Welcome back to the European Open, down 2.5% on European stocks. Centrica, an energy company, supplies houses and businesses in the UK. That stock is trading weaker. The company says it has a revised operating model. It's going to remove 3 management layers and it is cutting around 5,000 jobs across the group. We'll watch that story. Now, one of the world's biggest sovereign wealth funds says it's ready to use its growing cash pile to buy more assets. Abu Dhabi's Mubadala has $230 billion under management and is looking at equity investments across the globe, with the US as a potential target area. Bloomberg's Manus Cranney spoke to the deputy CFO.
Today, equity market plays a major role in our positions on the equity market. And as you know, we have seen a great recovery in 2019 for the equity market. As you would recall, we have struggled at the end of 2018 with the volatility in the equity market, but the market have recovered since then. But overall, we have seen really a great performance in different parts of our portfolio.
When you look at the divestments, you're obviously building up a sizable cash pile. Give us an indication. How much cash are you sitting on? And is that a cash pile for deployment?
We need to look at Mubadala today at the size of the investment, at the size of the portfolio that we have today. Today, we need to understand that Mubadala has an investment strategy, and that investment strategy has an asset allocation that has been allocated for the different asset classes and sector. So the recycling of capital, it's not something systematic. It's something based on allocation that has been given to the different business units, and they are playing tactically, either on the private equity side through the funds and the co-investments, or through the public investments, which is today a sizable. Today, if we look at our public investments and the overall portfolio is 21%. So recycling that within the public investments, it creates a large recycling capital for us.
Well, when it comes to doing deals, I look at your debt-to-equity ratio. It's 11.8%. You're the deputy CFO. Is the ambition to take that ratio higher, the debt-to-equity ratio higher? Where is your comfort level on that going into 2020?
Remember, Mubadala has been always prudent when it comes to their balance sheet. We are not looking to have an excessive leverage in our balance sheet. Today, when we look at our cash in the banks or even assets that are highly liquid on the public equities, we can easily meet our debt obligations. That's one. 2, we have built a dry powder over the last 2 years. Mubadala have gone through a lot of monetization in 2018 and 2019. We have anticipated a market correction, but definitely not COVID-19. And maybe to some extent, we had that luck of raising also money from the debt capital market. Back in November, we have raised $3.5 billion. Also last May, we have raised $4 billion. All this dry powder have built a strong cash position for Mubadala, where we're looking to deploy that across different sectors and asset classes in Mubadala.
Which naturally brings me, is $7 billion the right number for you? Do you want to come back to the debt markets? Money is cheap. It makes sense. Will you return to the debt markets in the second half of the year?
You are absolutely right. If I will look at the cost of funding for Mubadala on the money that we have raised on the last 2 issuances of the $7.5 billion, it's 3.2%. Way too cheap compared to the issuances that we had few years back or relative to any investment companies in the region. So far, we don't have any plans to come to the market.
And I want to get a sense from you. What are the businesses saying? Are you moving more towards a V-shaped recovery? What is the narrative that your businesses are telling you about the global recovery in a post-COVID world?
I think within Mubadala as a group, the first thing that we try to do with these businesses is to tap into the RCF and the line of credit to ensure there is enough liquidity, especially companies that have been impacted by the lockdown or by the COVID-19 because of the shutdown in operations. Clearly, when you look into the US market today, the equity market has almost erased all the losses that they have incurred on the back of 19. Now the question is the real economy. Are we going to see that catch up? If I take an example, the US market, which is a huge market that we invest in, I believe the U.S. market is very resilient. I mean, the U.S. market pre-COVID-19 had a very low unemployment rate. It's the lowest on the last 50 years. We don't see any systemic risk. We have seen a strong capitalization in the banking system in the U.S. And more importantly, the U.S. government, as well as the monetary policy, has been very supportive of the capital market. I think it would go down to, on the next few weeks, which we have really a limited data, is are we going to see another lockdown? It seems the US President Donald Trump, he is not going to close down the economy because of the next election that is coming in September. So I think our eyes should be on the job creation and the acceleration of job creation in the US, which will actually increase the consumer sentiment and spending, which is 60% of the US GDP.